Gold just hit a historic high, but this bull run isn't over yet. There are two black swan events that will explode gold prices even further. So gold has gone above 2080. This is a record-breaking price. And what we are seeing is the breakdown of the financial system. And gold is reacting as a real store of value, a true safe haven during this period of chaos. Now, something very interesting is happening with gold. We have interest rates rising at the fastest pace in modern history. The Federal Reserve has hiked rates above 5%, and this should be bearish for gold. Where interest rates are high, investors normally run to bonds and treasuries to get a higher yield. But if that's the case, why is money still flowing to gold? And the answer is simple. The entire financial system is broken, and people know it. Four banks have collapsed, the government keeps bailing out Wall Street, and you have an epic wave of de-dollarization happening. We are seeing a breakdown of trust in the global financial system. And it's not just the man on the street that's buying. Central banks are also buying gold like there's no tomorrow. Even before all the chaos in 2023, before the SVB collapse, central bank gold buying was the highest in 2022. That's a 55-year high. They bought over 1100 tons because they know the end game. Fiat currencies are dying and inflation will always be a problem. But it goes beyond just an inflation hedge. Now, Mark Twain has a very famous quote, and it's the ultimate financial advice today. The return of my money is more important than the return on my money. And I really want us to understand what this means. You can have all the returns in the world, a stock that doubles, a bond that pays you 10%. But if you can't get back your money, you are screwed. You want the return of your money, not just the return on it. Profits are great, but if you can't get it out of the financial system, what good is it? And this is why the ultimate driver for gold prices today is counterparty risk. People and central banks don't trust the dollar system anymore. They are getting out of the Roach Motel. So am I still buying gold? Yes. Am I cashing out at these prices? No, because there are still two black swan events on the horizon that no one is talking about. Events that could collapse the financial system and that will send gold to the moon. Now, the first is bank depositors losing their money, and the second is the confiscation of Russian reserves. Now, I'm not saying either of these would definitely happen, but if things continue down this road, it is not impossible. The blowback will just wreck the entire system, and this is why we cannot totally dismiss it. But let's go through the first black swan event, which is bank depositors getting screwed. And when you deposit your money into a US bank, you are insured up to $250,000. That is the FDIC insurance limit. So come hell or high water, you'll be paid back up to $250,000. But if a bank collapses and you hold more than 250 grand, you could lose everything above that amount. Those are called uninsured deposits, and there's a ton of it sitting in American banks. Just take a look at this disaster. This is a chart of the top US banks by uninsured deposits. There is a massive amount of depositors just sitting on a time bomb. We can see the infamous SVB and Signature Bank in red. 90% of their deposits were uninsured, meaning they were above $250,000. In fact, there was $7 trillion of uninsured deposits on this list alone. But just because you have a lower ratio of uninsured deposits doesn't mean you won't collapse. First Republic Bank, the one that I just cancelled out, only had a ratio of 67% when it still went under. When confidence is lost, it goes out the window real quick. So every bank on this list isn't immune, and unless you are too big to fail bank, you could still collapse. However, there's a big problem with the FDIC insurance. They don't have enough money even for the insured depositors. And let's take a closer look at this horror story. I call it the deposit insurance bubble. And if things get bad enough, it will pop. As of the end of 2022, the FDIC had just over $128 billion in its deposit insurance fund, backing more than $10 trillion in insured deposits. This is insane. This means the FDIC only has 1.3% of the money to pay back depositors. Mind you, these are insured deposits, the one with the $250,000 guarantee. We haven't even touched the uninsured money yet. And it gets worse. For over 15 years, the reserve ratio of the Deposit Insurance Fund, or the DIF, has never gone above 1.5%. Yes, the amount of absolute money is increasing. but it is still barely covering the amount of deposits in the system. So just imagine if banks start falling like dominoes. What is the FDIC gonna do? Where are they gonna go? For the insured deposits, the FDIC will have to go to the Treasury or the Federal Reserve for money. Powell will have to print up a bunch of dollars to backstop the FDIC. And what does this do? It expands the money supply and ejects cash directly into the system. You get higher inflation from all these new trillions of dollars. The uninsured depositors, on the other hand, get screwed. Yellen has said before that not all uninsured deposits will be guaranteed. They will suffer a bank bail-in, which means the banks will take your money to stay solvent. They will cancel your deposits because it is a liability to the bank. No matter how you want to spin it, your money is gone. That's why 2023 is essentially a masterclass in counterparty risk for the man on the street. And it isn't just bank deposits that are at risk. All types of investments in the financial system have counterparty risk. It doesn't matter if it's stocks or bonds, the banking crisis has taught us that nothing is truly safe. There's nowhere to hide when a real collapse happens. Remember the Credit Suisse collapse? When UBS took over, bondholders lost over $17 billion of value. Now, bonds are supposed to be safer instruments, but when an entity goes under, good luck trying to recover it. The same thing happened with First Republic bonds. They crashed to zero or near zero because JP Morgan didn't want to take on the burden of paying back the corporate debt. They chose the best part of the carcass and threw the rest into the dumpster. So if you're the average Joe investor and you see this, you'll be terrified and your first instinct will be to run to US Treasuries. Why don't I buy a bunch of US government bonds? After all, Uncle Sam can never default, right? And this is where things get really dark because it is still a lose-lose proposition. Right now, we are seeing the ultimate dog and pony show on Capitol Hill. The debt ceiling of 31.4 trillion is about to be breached in June. The US could face a default on its debt, but either way this plays out, it is terrible for bondholders if the US decides to default on its debt. You will set into motion a deadly chain of events. And let's say the US can't pay interest on its debt anymore and does a technical default. Now the US Treasury can't borrow more money to raise cash to fulfill all this long list of obligations. Janet Yellen can't issue any more Treasury bonds or bills. Suddenly, the bond market will freeze up because no more fresh money is coming to pay back the existing bond holders. Bond values will collapse. And if you want to exit, you will be taking a massive haircut on your Treasury holdings. And welcome to counterparty risk. Your money in US bonds is subject to the ability of Janet Yellen to borrow more money to pay you back. And in the second scenario, the debt ceiling gets raised and bondholders are still getting screwed. Sure, they will give back their money, but it will be worth less because now the dollar gets weaker. It loses more purchasing power. More money is borrowed into existence, which increases the money supply. And something tells me the money won't be used productively to increase the supply of goods and services. The White House has published a doomsday chart. It shows how a debt default could cost the economy millions of jobs. According to their estimates, over 8 million jobs will evaporate in Q3 alone, and in total, over 17 million jobs in the US will be lost over the next 3 quarters. However, if the debt ceiling is raised, the economy will be safe and almost a million jobs will be added. But I have a big question. How many of these jobs are actually productive jobs that increase the production of the things we need? Do these jobs increase the supply of commodities and finished goods? Because something tells me that this probably isn't the case. So it's really no surprise why people are flocking to gold and pushing the price up to all-time highs. There's counterparty risk no matter where you go. Trust in the system is breaking, and when people are afraid, they run to gold. However, that is just on the retail side. The biggest buyers of gold, central banks, are also facing the ultimate counterparty risk, and that is the threat of sanctions. Central banks in the East, especially China, they are afraid of their assets getting taken away. They are living in a shroud of dollar weaponization, and this fear is becoming increasingly real. This is where we need to talk about the Russian assets. Now, there are 3 levels of weaponizing the dollar. The first 2 have already happened. And the first is blocking the Russian banks from accessing the SWIFT system. And this cuts them away from the dollar system that makes up over 45% of transactions on SWIFT. And that is the huge market gone. Now, the second is freezing Russian assets, putting the reserves into an indefinite limbo, and that is bad enough. But the third level is where all hell breaks loose. We are talking about a full confiscation, seizing the assets to give to a third party, giving it to Ukraine. Now, before you say that is unlikely, we need to consider the situation. Back in November 2022, the United Nations passed a resolution for Russia to pay reparations for the damage done to Ukraine. 94 members voted for the resolution, while 14 voted against it, with 73 members abstaining. So the majority of the world is putting pressure on Russia to pay for the war, and the West is exploring options to get this done. They have tallied up how much Ukraine's rebuilding will be and how much Russian assets are trapped away. We have $1 trillion of assets from the Russian oligarchs, of which $58 billion have been frozen. Russia's central bank has $300 billion missing, of which $100 billion has been put on ice. The EU has earmarked $650 billion as the compensation amount. So if they move to confiscate the Russian assets, all of the reserves alone will get swallowed up. In fact, the EU is already calculating how much returns they can get by investing the money into European bonds, and the number comes out to be a 2.6% return, which is, to be honest, very low. They might as well take the money and give it to the United States to roll into US treasuries that yield way more than just 2.6%. But all jokes aside, they are serious about it. They have even written a whole paper on it. And if that happens, we'll see central banks around the world, especially those in BRICS nations or the global south, just freak out. Just take a look at this chart of central banks that bought gold in 2022. We have Turkey, China, Egypt, Qatar, and India all buying. These are countries in the global south that are protecting their wealth away from the West. In fact, there's also unreported buying of 741 tons. So it wouldn't surprise me if certain Western countries are secretly hedging away from the dollar. Obviously, they don't dare to report it, but the aim of central banks is to store value and reduce counterparty risk. So let's understand this. When central banks see counterparty risk, they start to de-dollarize and move away from the dollar. According to the former Morgan Stanley currency guru Steve Jan, de-dollarization is happening at a stunning pace. The reserve status is taking a hit. In real terms, it has actually dropped by 19% over the past 20 years. Just take a look at the huge drop in 2022 after the sanctions came online. Exceptional actions taken by the US and its allies against Russia have startled large reserve holding countries, most of which are emerging economies from the global south. And where are they going to run to? I can tell you the first choice won't be the Russian ruble, it won't be the Indian rupee, or even the Chinese yuan. Those are still fiat currencies. They share the same weakness as the dollar, as all fiat currencies do. They lose value over time, they can be horribly mismanaged, and they can also be sanctioned away as a last resort. Now, if you think the sanctions are scary today, just wait until we enter the era of CBDCs, central bank digital currencies. At least now, regulators still need to scramble to search high and low for the missing Russian assets. But just imagine if the US dollars are CBDCs, all consolidated under one ledger, each dollar with a serial number or code that can be tracked digitally. There'll be no running away. Any country can sanction their digital currencies by just flipping a switch or a mouse click. And that's why the real winner from this counterparty risk will be gold. If the West confiscates Russian assets, if they really do it, the smartest move central banks can do is to buy more gold. But it won't be the West that will buy, it will be the emerging economies that are less aligned with the United States. They will be the one that's buying. And this chart shows us the change in central bank gold reserves by alignment. Now the blue lines are countries closely allied to the United States. Basically, these are the G7 nations and France. The red and maroon lines are your rebels, countries like China and Russia who aren't on the Western agenda. Now, if you look closely, there's a very interesting trend that dates back to the 1990s. Countries aligned with the US has actually dropped their gold reserves allocation. This is a significant drop over the last 20 years. They are defending the dollar system. But take a look at the red line. It has exploded up, especially after the '08 financial crisis. Back then, the big fear was the Federal Reserve printing too much money and debasing the currency. But today, it will be the fear of sanctions and counterparty risk. And there's a good chance that all these countries especially the BRICS nations, aren't just buying gold to store value. And I think the game is finally up for the financial system. It has been exposed. These 2 years have alerted the world to the words counterparty risk. The man on the street is starting to wake up. They are beginning to see the regional banks collapsing and they are pulling their money out of the banks. Money is flowing to short term bonds and money markets because people are still chasing yield. But if enough banks collapse and the FDIC has to trigger a big payout, then depositors will get a rude awakening and flood into gold. And the same thing applies to central banks. If the West confiscates Russian assets, central banks will start rushing towards the exits. They will keep cashing out their dollars and piling to gold month after month because there's nowhere else safer to go. So this gold buying trend is not going to stop, but here's a very interesting possibility that we mustn't discount. What if private companies start buying gold to hedge themselves? What if companies like Apple or even Microsoft decide that buying treasuries isn't the best idea? Now, back in 2021, the technology company Palantir bought $50 million worth of physical gold bars. They had a lot of cash, so they bought a bunch of 100-ounce bars. So you just imagine if more companies start diversifying away from bonds and stocks into gold, this will trigger another big spike in the gold price because the metal is still under-owned today. So hang on tight, guys, because the gold bull market likely isn't over yet. But let me know what you think. How high can gold prices go? Do you still trust the financial system? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.